Equity investments represent ownership interests in companies and are among the most important asset classes in global financial markets. The program explains that equity securities provide investors with claims on a company's residual assets and earnings after all liabilities have been satisfied. Equity investors participate in corporate growth through dividends and capital appreciation, but they also bear greater risk because shareholders are subordinate to creditors during liquidation. Equity investments are widely used for long-term wealth creation, portfolio diversification, and participation in economic growth. Understanding the different types of equity investments is essential because each category offers distinct rights, risks, return characteristics, and strategic purposes within investment portfolios and corporate financing structures. Common shares are the most basic and widely traded form of equity investment. Holders of common stock typically receive voting rights, allowing them to participate in corporate governance through the election of directors and approval of major corporate decisions. Common shareholders may also receive dividends, although dividend payments are not guaranteed and depend on company profitability and management policy. The program emphasizes that common shareholders benefit from unlimited upside potential if the company grows successfully, but they also face higher risk because they are last in priority during bankruptcy or liquidation. Common stock performance is therefore closely linked to business profitability, growth expectations, economic conditions, and investor sentiment. Preferred shares represent another important category of equity investment. Preferred shareholders generally receive fixed dividend payments and have priority over common shareholders regarding dividend distributions and liquidation claims. However, preferred shares usually do not provide voting rights. Preferred stock combines characteristics of both equity and fixed income securities because dividend payments resemble bond interest while ownership claims remain subordinate to debt obligations. Some preferred shares are convertible into common stock or callable by the issuing company. The program notes that preferred shares are often used by companies seeking financing flexibility without increasing traditional debt levels. Investors may prefer preferred stock for its relatively stable income and lower volatility compared with common equity investments. Private equity investments involve ownership interests in companies that are not publicly traded on organized exchanges. Private equity includes venture capital, growth capital, leveraged buyouts, and distressed investing strategies. These investments are typically less liquid and require longer investment horizons than publicly traded equities, but they may offer higher return potential because investors can participate directly in business development and operational improvement. The program explains that private equity investors often take active roles in management and strategic decision-making. Because private companies are not subject to the same disclosure requirements as public firms, private equity investing also involves greater information asymmetry, valuation uncertainty, and operational risk requiring specialized analytical expertise. Equity investments may also be classified according to company size, investment style, or geographic focus. Large-cap equities generally represent established companies with stable earnings and lower volatility, while small-cap stocks may offer higher growth potential but greater risk. Growth stocks emphasize future earnings expansion and often trade at higher valuation multiples, whereas value stocks appear undervalued relative to fundamentals such as earnings or book value. International and emerging market equities provide geographic diversification but may introduce additional political, currency, and economic risks. Analysts evaluate these characteristics carefully because different equity categories respond differently to economic cycles, interest rates, inflation, and changing market conditions affecting portfolio performance and diversification benefits. A strong understanding of equity investment types is essential for portfolio management, valuation analysis, and investment decision-making. Different forms of equity securities offer varying combinations of risk, return, liquidity, income potential, and governance rights. The program emphasizes that investors select equity investments based on financial objectives, risk tolerance, investment horizon, and market expectations. Analysts integrate financial statement analysis, valuation methods, and industry research to assess the attractiveness of different equity opportunities. Because equity investments play a central role in wealth creation and corporate financing, understanding their characteristics improves investment strategy design, portfolio diversification, and long-term financial decision-making within increasingly complex global capital markets.